What separates the rich from everyone else? Is it luck, talent, or education? Robert Kiyosaki's answer is none of these. The real difference lies in how the rich think about money, especially when it comes to investing. Most people work hard for money, but the rich make money work for them. In Rich Dad's Guide to Investing, Kiyosaki reveals the mindset, habits, and financial intelligence needed to become not just rich, but a successful investor. This book isn't about shortcuts. It's not a get-rich-quick scheme or a list of hot stocks to buy. Instead, it's a guide for those who are truly serious about achieving financial freedom, those who are willing to think differently, learn consistently, and take calculated risks. Kiyosaki emphasizes one truth again and again. Wealth is not about how much money you make, but how much you keep and how effectively you invest it. Before diving into practical tips, Kiyosaki invites us to shift our perspective. He says that most people plan their lives around earning and spending, working jobs, collecting paychecks, and hoping that one day they'll save enough to retire. But investors play a different game. They plan their lives around creating assets, using money as a tool to generate more money. Kiyosaki introduces the core idea that you need to be an investor before you can invest like one. That may sound confusing at first, but what he means is simple. The rich don't wait to become wealthy before thinking like investors. They adopt the mindset and habits of investors early on, which in turn leads them to wealth. It's a mental shift from being someone who earns money to someone who understands how money grows. In this audiobook summary, you'll learn the principles that guided Kiyosaki from being broke to building long-lasting wealth. You'll discover the types of investors, the power of financial education, and why building a business can be your most powerful investment. Whether you're just starting or already on your journey, this guide will challenge your assumptions and reshape how you approach money. So let's begin, not with a promise of easy riches, but with a powerful mindset that can change your financial future forever. The investor mindset. Before Kiyosaki teaches you what to invest in, he focuses on who you must become to invest wisely. That's because real investing isn't just about numbers or markets. It's about your mindset. Most people think investing is about finding the next big opportunity or getting rich fast. But Kiyosaki warns, if you go in with that mindset, you're likely to lose more than you gain. He introduces two key characters again, Rich Dad and Poor Dad. Poor Dad, his biological father, was highly educated and believed in working hard, saving money, and living below his means. Rich Dad, his mentor and the father of his best friend, had a completely different approach. He believed that financial freedom didn't come from saving. It came from understanding how money works and how to make it grow. Rich Dad taught him that the average person sees money as something to be earned and spent. But an investor sees money as a tool that should be multiplied, protected, and strategically used to buy assets that generate more income. It's this shift from consumer to creator, from spender to investor, that changes everything. Kiyosaki says, if you want to be a successful investor, you must train your mind to think like one before you ever make a single investment. That means letting go of fear. It means moving away from the employee mentality, where job security and paychecks are the focus, and stepping into a world where you create your own security by controlling your income sources. One powerful lesson from this section is the idea of being in control. Poor Dad always relied on someone else, an employer, a pension, the government. But Rich Dad believed in taking control of your financial future by building your own sources of income. Investing isn't just about putting money into stocks or real estate. It's about learning how to think independently, manage risk, and make confident decisions even when others are afraid. Kiyosaki reminds readers that the rich aren't necessarily smarter. They're just better trained. They study money the way a doctor studies medicine. They read financial reports, analyze businesses, and seek mentorship from others who are more experienced. Most importantly, they see mistakes not as failures, but as opportunities to learn. Kiyosaki makes one thing clear. The journey to becoming a successful investor doesn't begin in the stock market. It begins in your mind. The rich don't invest for retirement. Robert Kiyosaki challenges one of the most common financial goals people are taught to chase: retirement. From a young age, many are told to work hard, save money, and invest in retirement plans like 401ks or pension funds. But Rich Dad taught Robert a very different lesson. The rich don't invest to retire. They invest to achieve financial freedom. The idea of working until 65, then finally relaxing, is not the dream of the rich. In fact, many wealthy people never really retire. Not because they can't, but because they don't need to. They've built systems, businesses, and investments that generate income whether they work or not. Their goal is not to stop working, but to reach a point where working becomes a choice, not a necessity. Kiyosaki points out that traditional retirement plans are designed for people who rely on a job as their only source of income. These plans often involve giving your money to others, to fund managers, to companies, to banks, and hoping that it grows over time. But real investors don't rely on hope. They want control. They want to understand where their money is going, how it's working, and how to make it multiply. Rich Dad's strategy was different. Instead of handing money over to someone else, he encouraged Robert to build assets that produced income: real estate, businesses, intellectual property. These are investments that don't just sit in an account waiting for compound interest to work. They generate cash flow today. And with the right knowledge, you can grow them over time while maintaining control. Kiyosaki emphasizes that financial freedom is not measured by a number in your retirement account. It's measured by how long you can live without working, how much your assets produce each month compared to your expenses. If your investments generate more income than your lifestyle requires, you are free no matter your age. In this way, the idea of retirement becomes irrelevant. The real goal is independence, and that means thinking beyond savings accounts, beyond mutual funds, and beyond conventional advice. It means learning how to create wealth that lasts, wealth that gives you the time and freedom to live life on your terms. What kind of investor do you want to become? Not all investors are the same, and understanding this is crucial. Kiyosaki explains that before you invest a single rupee or dollar, you need to ask yourself, what kind of investor do I want to become? This isn't just a question of strategy, it's a question of identity. Because the way you see yourself as an investor shapes the choices you make and the risks you're willing to take. Rich Dad taught that there are generally three broad categories of investors. The first is the do-nothing investor, someone who avoids investing altogether out of fear or lack of knowledge. These people often keep their money in the bank, earning almost nothing, while inflation slowly erodes their wealth. The second is the traditional investor, someone who follows the mainstream path. They invest in mutual funds, index funds, or employer-sponsored retirement plans. They often rely on financial advisors to make decisions for them. They don't want to be too involved. They just want their money to grow safely over time. And while there's nothing wrong with this approach, it's limited. It rarely creates financial freedom. Then there's the third type, the sophisticated investor. This is the investor Rich Dad encouraged Robert to become. A sophisticated investor doesn't follow the crowd. They seek financial education, understand how markets and businesses work, and make decisions based on knowledge rather than emotion. They might invest in real estate, start or buy businesses, or even develop new products. But they never hand over control blindly. They study, prepare, and take calculated risks. Kiyosaki points out that the sophisticated investor sees money differently. While others see it as a reward for hard work, they see it as a resource to build systems that generate income without constant labor. It could be a rental property that brings in monthly rent, a product that sells online, or shares in a company that pays dividends. The point is, their money works harder than they do. But becoming a sophisticated investor takes time. It takes learning, mentorship, and sometimes failing. Rich Dad told Robert, "You need to invest in your financial education before you invest your money." That advice changed his life, and it's the reason this book exists. So before rushing into any investment, Kiyosaki encourages readers to take a deep breath and ask, what kind of investor do I want to be? Your answer will define your path. The importance of financial education. To become a successful investor, Kiyosaki emphasizes one foundational truth. Financial education is everything. Without it, even the best investment opportunities can turn into losses. With it, even average opportunities can grow into wealth. Most schools teach us how to earn money, how to become employees, work for a paycheck, and follow rules, but they rarely teach us what to do with that money once we have it. This is why so many hard-working people struggle financially. They know how to make money, but not how to manage, protect, or multiply it. Rich Dad believed that the difference between the rich and the poor isn't how hard they work. It's what they know about money. The rich study financial statements. They understand cash flow, income, expenses, assets, and liabilities. They know how to read a balance sheet the way others read a novel. It's not about being a math genius. It's about learning the language of money. Kiyosaki shares how his rich dad would sit him down with real financial reports, explaining how businesses make and lose money. He was taught to see money as something dynamic, always moving, always flowing, never static. That's why financially educated people aren't afraid of recessions or crashes. They see them as opportunities. When everyone else is panicking, the educated are preparing to buy. One key lesson here is that an educated investor doesn't gamble. While many confuse investing with speculation, Kiyosaki draws a clear line. Speculators throw money at opportunities they barely understand, hoping to get lucky. Educated investors analyze, calculate, and act with intention. They take risks, yes, but those risks are measured, informed, and strategic. Another major point Kiyosaki makes is that financial education isn't a one-time thing. It's a lifelong process. The markets change, laws change, opportunities shift, and the successful investor is always learning. Reading books, attending workshops, listening to mentors, even learning from personal failures. It all adds up. He also emphasizes that real education often comes from doing. You can read 100 books on real estate, but until you buy your first property, you haven't truly started learning. So, Rich Dad's philosophy was simple. Learn, apply, reflect, repeat. If you want to achieve lasting wealth, Kiyosaki says, don't chase tips or trends. Instead, build a foundation of knowledge that lets you see opportunities others miss and avoid mistakes others can't see coming. Build a strong business first. One of the most surprising lessons in Rich Dad's Guide to Investing is that before you become a great investor, you should consider becoming a business owner. According to Kiyosaki, the richest and most successful investors didn't start by picking stocks or buying property. They started by building businesses. Why? Because a business is one of the most powerful assets you can create. Unlike a job, where your income is limited by your time and your employer's rules, a business can grow beyond your personal efforts. It can scale, generate cash flow, and give you control over your financial future. More importantly, a business teaches you how money, people, systems, and markets work, which are all essential skills for any serious investor. Rich Dad believed that being a business owner trains your mind in a way that no job can. You learn to take responsibility, make decisions, manage risk, and solve problems creatively. These aren't just entrepreneurial skills, they're investor skills. When you run a business, you're constantly analyzing income, expenses, return on investment, and long-term strategy, exactly what a good investor must do. Kiyosaki explains that one of the reasons most people never become wealthy is because they stay stuck in the employee or self-employed mindset. They trade time for money. Even if they earn a good salary, they're still limited by hours and energy. But business owners create systems. They build teams. They find ways to make money flow even when they're not working. And that's the mindset of a true investor. Another important point is that having a successful business opens up better investment opportunities. Banks are more willing to lend to you. Other investors take you seriously. You build credibility. You also have access to tools like business structures, tax advantages, and legal protections that most regular investors don't even know about. Kiyosaki doesn't say everyone must start the next big company. Even a small, well-run side business can teach you a lot and provide extra income to invest with. The goal isn't just profit, it's education. Running a business is one of the fastest ways to learn how money actually works in the real world. So, before you rush into buying stocks or real estate, Rich Dad advises, build your own asset first. Start something. Learn how to lead, how to sell, how to manage money. That experience will become your most valuable investment because it will prepare you for every opportunity that comes after. Invest in what you understand. One of the golden rules repeated throughout Kiyosaki's philosophy is this: never invest in something you don't understand. It sounds simple, but it's where most people go wrong. They hear a tip from a friend, see the market rising, or feel pressure to act quickly, and they jump into investments they can't explain. That's not investing, that's gambling. Rich Dad taught that true investors take the time to learn. They study the asset class, the risks involved, the market behavior, and how income is generated. They ask questions, they dig deep, and they never assume. It doesn't matter if it's real estate, stocks, mutual funds, or cryptocurrency. If you don't know how it works, you shouldn't be in it. Kiyosaki gives an example from his own life. He didn't start investing in real estate just because he heard it was profitable. He studied it for years, went to seminars, walked through properties, asked experienced investors questions, and ran the numbers until he understood it inside and out. When he finally started buying properties, he wasn't guessing, he was applying knowledge. This approach goes against the common behavior of emotional investing. People buy high because they see others making money and fear missing out. Then they sell low when the market drops, out of panic. Rich Dad would say, if you don't understand it, don't touch it. Emotion is the enemy of a good investor, and knowledge is the shield that protects you from fear and greed. Kiyosaki also highlights that understanding doesn't mean becoming an expert in every investment opportunity. It means knowing your area of strength. If you understand online businesses better than real estate, invest there. If you grasp the stock market and can read financial reports, use that skill. The key is to build a circle of competence, a space where you know more than the average person, and where your decisions are based on clarity, not hype. He also warns against blindly trusting others. Just because someone has a title like a financial advisor or a broker doesn't mean they're always right. You must take responsibility for your own decisions, and that's only possible when you truly understand what you're investing in. In the end, Kiyosaki's advice is empowering. You don't need to know everything. You just need to be willing to learn before you leap. The more you understand, the less you'll fear, and the better your results will be. The power of passive income. In the world of investing, there's one type of income that truly sets the wealthy apart. Passive income. While most people focus on earning active income through jobs or self-employment, Kiyosaki explains that true financial freedom comes when your money continues to grow and support you, even when you're not working. Passive income is money earned without constant effort. It could be rental income from a property you own, dividends from shares, royalties from a book or course you created, or cash flow from a business you've built that runs on systems. It's income that doesn't depend on your daily labor, and it's the goal of every smart investor. Rich Dad taught Robert that relying only on active income is like running on a treadmill. No matter how fast you go, the moment you stop, the money stops too. Passive income, on the other hand, is like planting a tree. You water it, protect it, and help it grow. And one day, it starts giving you fruit year after year, whether you work or not. Kiyosaki points out that many people never pursue passive income because it takes time to build. It's not instant. It requires planning, education, and effort up front. But the rewards are long-term and life-changing. Once your passive income exceeds your monthly expenses, you're free to spend your time however you choose, without financial pressure. This doesn't mean passive income is easy or that you can sit back and do nothing. In fact, it often takes active effort in the beginning. You might spend months researching a property, learning to build an online product, or working extra hours to fund an investment. But the key is that you're building something that continues to pay you back long after the initial effort is done. Kiyosaki also explains that passive income isn't just about money. It's about freedom of time. It gives you space to think, to create, to rest, and to live life on your terms. That's something a job, no matter how well paying, can rarely provide. He encourages readers to start small. Don't wait until you have a fortune to begin building passive income. Start with what you have, learn as you go, and build brick by brick. Whether it's buying your first stock, renting out a room, or creating a side hustle that runs itself, every step counts. Because at the end of the day, it's not how much you earn that matters. It's how much you keep, and how much of it keeps coming back to you even when you're sleeping. Understanding the difference between assets and liabilities. One of the most powerful lessons Robert Kiyosaki ever learned from Rich Dad, and a concept that changed his life, was the clear difference between assets and liabilities. It sounds simple, but Kiyosaki insists that most people misunderstand this basic principle, and as a result, stay trapped in financial struggle their entire lives. Rich Dad explained it like this. An asset puts money in your pocket. A liability takes money out of your pocket. That's it. No fancy jargon. No complicated definitions. Just a brutally honest test. Does it make you money, or does it cost you money? With that lens, Kiyosaki began to see the world differently. He realized that many things people consider assets are actually liabilities. Take a personal home, for example. Most people see it as their biggest asset, but unless it generates income, like through rent or a business, it's not really making you money. In fact, it's taking money out every month in the form of mortgage payments, taxes, repairs, and maintenance. That makes it a liability, not an asset. Rich people, Kiyosaki explains, focus on buying true assets, things that generate cash flow. This could be rental properties, dividend-paying stocks, businesses, or intellectual property like books or patents. Their goal is to build a portfolio of assets that continue to feed them financially over time. Poor and middle-class people, on the other hand, often buy liabilities disguised as assets. They finance cars, buy bigger homes, or spend on things that feel like wealth but actually drain their finances. And then they work harder to pay for those things, repeating the cycle month after month. This simple but life-changing distinction taught Kiyosaki a new financial strategy. Don't work for money. Build or buy assets that pay you. Every dollar that comes into your life should be directed toward acquiring something that will return more dollars to you. It's not about depriving yourself or being frugal. It's about being strategic. He also encourages readers to look at their personal financial statements, even if it's just a piece of paper, and honestly list what's putting money in and what's taking money out. When you start thinking this way, your decisions begin to shift. Instead of asking, "Can I afford this?" you start asking, "Will this make me money or cost me money?" By mastering the asset-liability distinction, Kiyosaki believes anyone, regardless of background or income, can start building real wealth. It's not about having a high salary. It's about owning things that work for you, not the other way around. The Cash Flow Quadrant. Knowing where you stand. To truly understand the journey from financial struggle to financial freedom, Kiyosaki introduces the concept of the cash flow quadrant, a tool that divides the world of income into 4 types of earners. This simple diagram, taught to him by Rich Dad, helped Robert see why some people remain trapped in the rat race, while others break free and create wealth that works for them. The quadrant is made up of 4 letters: E for employee, S for self-employed, B for business owner, I for investor. Each quadrant represents a different way of earning money, and each comes with its own mindset, risks, and rewards. In the E quadrant, you trade time for money. You have a boss, a salary, and maybe some benefits. There's a sense of security, but also limitation. No matter how hard you work, your income is tied to your time. If you stop working, the money stops. In the S quadrant, you're self-employed. You might be a doctor, a freelancer, or a small business owner who works alone. You have more control, but you're still trading time for money. Often, people in this quadrant are perfectionists. They believe no one can do the job as well as they can, so they do everything themselves. The result? They're overworked and still stuck. The shift begins in the B quadrant, the business owner. Here, you create systems and build teams. Your business works even when you don't. Think of McDonald's or Amazon, businesses that run with or without their founder. This is where financial freedom begins because income is no longer tied to your time. It comes from the system you've built. Finally, there's the I quadrant, the investor. This is the ultimate goal. People in this quadrant make money from money. They own stocks, real estate, or entire companies. Their wealth grows through passive income, dividends, interest, or capital gains. They don't work for money. Their money works for them. Kiyosaki stresses that the left side of the quadrant, E and S, is where most people live. It's where society trains us to be. But real wealth is created on the right side, B and I. The key is to begin transitioning your mindset and your actions toward the B and I side. But it's not about quitting your job overnight. It's about understanding where you are, where you want to be, and how to start moving. Start small, a side business, a rental property, or a stock portfolio. But start, because each step you take toward the right side of the quadrant brings you closer to freedom. Investing is a plan, not a product. One of the biggest misconceptions people have about investing is that it begins with picking the right product, the right stock, the best real estate deal, or the perfect mutual fund. But Robert Kiyosaki explains that this way of thinking is backward. Real investing doesn't start with products. It starts with a plan. When you buy a financial product without a plan, you're just reacting. Maybe the market looks hot. Maybe your friend recommended something. Maybe you're afraid of missing out. But acting on emotion or impulse leads to losses. Rich Dad taught Robert that the most successful investors are not product-focused. They're goal-focused. They invest with a clear vision of where they're going, how they'll get there, and why they're making each move. An investment plan is like a map. It guides your decisions, keeps you calm when the market shakes, and helps you measure progress. Without it, you're just wandering. With it, you're moving with purpose. Kiyosaki explains that your plan should be shaped by your personal situation. Ask yourself, what are my financial goals? How much risk am I comfortable with? What skills and knowledge do I already have? How much time and money can I commit? What kind of lifestyle do I want, now and in the future? Your answers will shape a strategy that's unique to you. There's no one-size-fits-all approach. A business owner looking to scale will invest differently than someone building long-term passive income through real estate. A young entrepreneur will have a different plan than a single parent nearing retirement, and that's okay. The key is to make your plan fit you, not the market trends or financial fads. Kiyosaki also warns about chasing investments just because they're safe or popular. If you don't understand why you're investing in something, it doesn't belong in your plan. Stick with what you understand. Build your knowledge step by step, and always invest with a long-term perspective. Having a plan also helps you avoid one of the biggest threats to investors: emotional decisions. Fear, greed, and impatience can wreck even the most promising investment. But when you have a clear strategy, you're less likely to panic in a downturn or jump into something risky just because it sounds exciting. Rich Dad often said, "The plan is more important than the product, because the right plan, consistently followed, can turn even average investments into great results." Prepare yourself before you invest. Before you put your money into any opportunity, Robert Kiyosaki urges you to do something far more important. Invest in preparing yourself. This means building the knowledge, mindset, and emotional discipline required to succeed. Because in the world of investing, it's not just the deal that matters, it's who you are when you step into the deal. Rich Dad's philosophy was simple. Don't just prepare to invest. Prepare yourself to be the kind of person who invests well. In other words, your internal development must come before external action. Most people want to jump straight to making money. They want the investment that pays fast, the shortcut to success. But Kiyosaki explains that impatience and lack of preparation are what make people lose money. Even a great opportunity can become a disaster if you don't know how to manage it, just like handing the keys of a sports car to someone who's never learned to drive. So what does preparing yourself really mean? First, it means educating yourself, not just about financial terms, but about the asset class you want to invest in. If you're interested in real estate, learn how deals are structured, what cash flow means, how to evaluate neighborhoods, and how to manage tenants. If you're drawn to the stock market, learn how to read financial statements, understand economic indicators, and manage risk. Knowledge builds confidence, and confidence reduces fear. Second, it means developing emotional intelligence. Investing isn't just a numbers game. It's a psychological battle. You'll face fear, doubt, greed, and regret. The prepared investor knows how to manage these emotions instead of being controlled by them. That's what allows them to stay calm when others panic, and to stay steady when others chase hype. Third, it means developing habits, the discipline to save money, to budget, to delay gratification, and to keep learning. Kiyosaki often reminds readers that how you do anything is how you do everything. If you're careless with small money, you'll likely be careless with big money too. Building strong habits now prepares you for the responsibility of handling more in the future. And finally, preparing yourself means being clear about your purpose. Why do you want to invest? What does financial freedom mean to you? When your reason is strong, you'll have the resilience to push through obstacles and setbacks along the way. In this chapter, Kiyosaki isn't handing out formulas. He's reminding you that you are your most important investment. Before you worry about finding the right opportunity, make sure you are ready. Because if you are prepared, opportunities will come. And when they do, you'll recognize them, act on them, and grow from them. How to find great investments. One of the biggest myths in the world of investing is that great opportunities are rare or reserved for the wealthy. But Kiyosaki disagrees. According to Rich Dad, great investments are everywhere if you know how to see them. The real challenge isn't availability, it's awareness. Most people miss out on life-changing opportunities not because those opportunities don't exist, but because they haven't trained their minds to recognize them. Rich Dad called this developing your investor's eye. It's not about luck or timing. It's about observation, education, and preparation. Just like a trained artist sees shades others miss, or a skilled doctor notices symptoms early, a true investor notices value where others see nothing. Kiyosaki shares that before he ever invested in real estate or businesses, he spent years walking properties, attending auctions, studying financial reports, and talking to experienced investors. At first he didn't know what he was looking at, but with time and repetition, patterns emerged. He began to see which properties had hidden potential, which deals were underpriced, and which businesses were silently thriving. Rich Dad's advice was simple. You don't find great deals, you create them. In other words, a smart investor doesn't wait for the perfect offer. They look for opportunities others overlook and then add value by negotiating better terms, improving the asset, or restructuring the business. So where do these opportunities come from? Sometimes they come through your network, people who know you're serious and share deals with you. Sometimes they come through deep research, walking neighborhoods, reading business journals, or studying market trends. But more often than not, they come from experience. The more you look, the more you learn. And the more you learn, the more obvious the good investments become. Another key insight. Great investments often come disguised as problems. A rundown property in a great location. A struggling business with poor leadership but strong potential. A stock that's undervalued due to short-term news. Most people avoid these. But trained investors know that problems often mean opportunity if you have the skill to solve them. Kiyosaki also emphasizes that finding good investments requires focus. Don't spread yourself too thin trying to chase every trend. Pick a niche like real estate, small businesses, or dividend stocks and master it. Become so familiar with it that you can spot a deal faster than most people can even evaluate it. Ultimately, the message is clear. If you want to find great investments, you must be actively searching, constantly learning, and willing to act when the right opportunity appears. The market rewards the prepared, not the passive. The journey to becoming a successful investor isn't about chasing the next hot stock or waiting for the perfect moment. It's about becoming the kind of person who sees opportunities, takes responsibility, and makes decisions with clarity and confidence. That's what Rich Dad's Guide to Investing is really about. Not just building wealth, but building wisdom. Robert Kiyosaki doesn't offer a formula to follow. Instead, he offers a mindset, one that sees money as a tool, not a goal. He teaches us to look beyond jobs and paychecks, beyond fear and doubt, and into a future where financial freedom is built through discipline, learning, and action. In the end, the richest investments you'll ever make are not in stocks, real estate, or businesses. They're the investments you make in yourself, in your growth, your knowledge, and your ability to take control of your financial destiny. Thank you for listening to this audiobook summary of Rich Dad's Guide to Investing by Robert T. Kiyosaki. I hope these lessons have inspired you to start thinking like an investor, not someday, but starting today. If this summary helped you gain clarity, take that first step toward building your own financial freedom. Begin small, stay consistent, and never stop learning. What was the most valuable lesson for you? Let us know in the comments. And if you enjoyed this summary, don't forget to like, share, and subscribe for more powerful ideas that can transform your life. Your journey toward wealth and independence is just beginning. Keep going. Until next time, keep growing, keep learning, and remember, you are your greatest asset.